Welcome to the daily update, where I'll go over the action in the market for Friday, October 4th, and then we'll see how things look for Monday, October 7th. We had a positive reaction to the employment situation report. It came in much stronger than expected. At the same time, interest rates are going back up, and we're below average with volume. So, is this really starting to change things back more positive? Now, our charts are still looking pretty positive, except this concern about volume being below average. We have this Hindenburg Ullman in the background and weak seasonality in the background, which just has not materialized, at least yet. We want to be aware of that, but we follow the charts, with price being the most important indicator, and then what our calculations of the other indicators are showing us to give us some insight as to what's actually happening in the S&P. Before I get started into the video, there is a thing called the SPXInvesting Program. It is now up, it's going, it's currently free. It'll be free probably until the end of 2024. Feel free to check that out. There are additional videos that I post there. There's strategies that I talk about. There's extra courses that I either have already posted or will be posting, both the live version that you can participate in and pre-recorded versions of courses that I'm rolling out. You also get immediate access to the videos, the daily videos and weekly videos that I do right after they're available, where I delay that on YouTube and Rumble. The daily video, that's where the real analysis comes from. I know my videos are longer, and quite honestly, they're made that way on purpose. People that are looking for fast answers, I want them to go away. I want people that really want to study the market and really understand the different relationships going on inside of the market. That's how you're going to succeed. It's not just coming across one or two indicators or coming up with some crazy conclusion that may be real or not real based in reality. But we look at things, we try to remove as much emotion as possible, and I try to do that in the daily video. It takes more effort to be successful. I know there's people that are new in the market. They haven't been doing this for very long. They think they know everything, but they typically don't last very long. I'm trying to develop and show you the program that has served me for decades, and I'm trying to teach a skill that will also serve you for decades, even if I'm not in the picture anymore. So the daily video is the real hub of the analysis that I do. The weekly videos are on the outside. I prepare those over the weekend. I'll get those posted as soon as possible. They're meant to supplement into the daily video. All right, let's go back and talk about what happened. We had a gap higher open, so there was a positive reaction to the employment situation report. We opened up at R2 at 57.40. And then we declined. Looked like, okay, we're seeing some selling into strength here. We went down below R1 at 57.20. Then we chopped above and below R1. There was really no conviction. Yeah, we closed higher and we had a nice little run up going into the close. That was the only real conviction that we saw. But for most of the day, we just chopped around above and below R1. We were able to get back up to R2 and then close at the intraday high. So that is positive in and of itself. We were up 0.9%, but on below average volume. This is the most important economic report of the month. This coming week, we'll get probably the second most important report, which is CPI. But to have the number come out the way it did and not see an increase in volume, just a warning sign, not making a declaration of anything, because we've seen some rising over the summer months and now into the fall, where we're going up with the S&P, but volume is actually dropping off. But now there's some other charts that we look at that show that volume is actually looking a little bit better than price right now. So that's part of the balancing act that we have to put all together to reach our consensus as to what's happening with the S&P. We are positive in the short, intermediate, and long term. I measure that according to where are we with the 20, 50, and 200-day moving averages. And inflation, I thought the report might eventually freak the market out because we saw an increase in earnings, a decrease in the hours worked, a number that was a lot higher than expected. And you take that, and if the market is more focused on the negative side of things, it could have freaked out over this report, saying, oh no, interest rates are going back up. Didn't seem to matter on Friday. Is that going to matter in the upcoming week? And then we have the geopolitical things, specifically what's going on in Israel, and that's pushing oil back up. If oil keeps going up, that could also have a negative impact on stocks. Because oil can go up if the stock market's going up, because the oil companies are doing better and their earnings are improving and all of that. That's when they can move together to the upside. But when oil goes up for other reasons, geopolitical, that means something is wrong in the world and that can pressure stocks. Okay, some comments. The Dow did close at a new all-time high, and the S&P is well back above 5,700 now, where after Thursday we were below, or excuse me, we were right about at 5,700, but a little bit below it there. Mega caps and semis outperformed. This is what helped the indexes go higher. We need these big stocks to do well and the semiconductors to do well and the tech sector to do well to really drive the indexes higher. Now, the rest of the index, the S&P 500, has 503 stocks in it. They're doing okay. They're doing really well right now, but they don't have as much of an impact on the calculation of the S&P 500 because it's a weighted index. The bigger companies have more of an influence. That's why we compare it with the equal weight version of the S&P 500. There is an escalation in the Middle East, and Israel says, yeah, it's going to strike back at Iran, and it's probably going to be hard, fierce, and they're taking out, at least going after, leaders that have already been taken out of the equation. Now they're starting to go after the new leaders that are supposed to take their place. And oil is rising because of that. And so we want to keep an eye on that situation as it applies to the stock market. Now, you may also keep an eye on this because it's an interesting thing to you. You may be Jewish, you may be Palestinian, you may be Muslim. And so you're focused on things because of that reason. We mainly focus on it for this video for how does it impact the stock market, leaving the other things to deal with in other ways. Okay, on a short-term basis, our Williams percent R's back up to being extreme. That could also suggest good momentum. The slope oscillator is still extreme, but it's down below its moving average. So it's actually declining still, even after the update on Friday. And the stochastics are looking extreme. And I'll have charts to show you of all these things. We do have the TTM squeeze, which is now declining and turning more negative, but it's still extreme. It's above the black line that I put on the chart. The PMO studies, the Sean Trend Meter is a new addition to the list. The bullish percent index for the S&P. Now, it got up to a very high reading, started to come down, but in Friday's session, it ticked back up. And then the money flow, as well as the 10-day new highs, new lows for the S&P. And our long-term, over extended to the upside indicators that we're watching right now is the 150 and 200-day simple moving averages, as well as the exponential moving average for the S&P. The Fed did come in and cut rates. It looks like the soft landing scenario is very possible, and Friday's report actually confirmed that. We don't see an increase, especially greater than expected, if we're going into a recession with the number of new jobs that came out. And I'll go through the numbers here in a moment. The Fed had kept rates higher for longer because the employment situation was really holding up well. Even though they're coming in, starting to cut rates, other parts of the economy are seeing some improvement. Employment is still looking strong for right now. And so that's why the market is still treating things as positive and having more of a tendency to go up than down currently. The dollar was up and interest rates are up. Now, usually both of these together would impact stocks, but it didn't seem to matter on Friday. And we're getting close to that 4% level again with the 10-year yield. We're at 3.98%, where after Thursday, we were at 3.85%. So that's a pretty big jump in interest rates. We're still inverted with the 10 to the 3-month, and we're coming back up, but we still have a ways to go with that chart, where the 10 to the 2 is actually declining, but still uninverted. It's still back to being normal there. And we're watching sentiment too. If we get to that 75 level, That's where we start to look extreme positive. Now we're at 74 right now, where we had been at 67. When we get above 75, that means folks are getting a little too happy about things. And that's when we say, okay, the, we're concerned that the exuberance is too much right now, and we're looking for things to turn in the other direction. So this tries to gauge what's the emotion in the market. And when everybody's happy, when everybody takes the market for granted, that's usually when we see a turn of things. Okay, the trend. Not really improving all that much here. We're still positive, but the ADX, both in the short and intermediate term, is still below its moving average. It's trying to turn up, but it hasn't crossed above those moving averages yet. So it still suggests a weakening trend, but we're still trending because we're above 20. And I'll show you that chart as well. With the up day, our bias is positive. I'm still keeping the momentum at mixed for right now because this below average, we're seeing a lot of choppiness intraday. We do close higher, then we close a little bit lower. There's not an awful lot of conviction in the market right now. So that's why I'm keeping momentum at mixed. And I like to point this out from time to time. I try to let the charts tell us what's actually happening and not putting my own opinions into what I see. Now, sometimes you might disagree with how I interpret some of the charts, and that's fine. But I'm trying to just let them say, okay, we can clearly see that's positive or negative. Well, the bias and the momentum here on this chart, this is me. This is more subjective. This is where I'm coming up with my own conclusion about things. So you can take that for what it's worth. All right. So the economic reports that came out, we had the non-farm payrolls much higher than expected, up 254,000. They expected 135,000. So a lot stronger than expected. And last time we had 159,000. And that was revised up from 142,000. Excuse me. One of the concerns that we were starting to see here is that they were revising previous months down. Well, this time they revised it up. So that's a little more encouraging as well. Non-farm private payrolls also much stronger than expected. 223,000. They expected 125,000. They actually did revise this down a little bit. 114,000 or the last time we had the report, it was at 118,000. Average hourly earnings were up, and this you could read some inflationary concerns into this because people are making more money. When they make more money, they spend it. Prices go up. It came in up 0.4% where they expected 0.3%, but it was down from the 0.5% we saw last time, which was revised from being up 0.4%. So they bumped that up a little bit. The market could have fixated on this and just freaked out, but it didn't. Unemployment rate coming down 4.1%. Yes, we're in an election year. I don't trust the unemployment rate all that much. I don't trust any of these reports to be realistic, but it's what the market uses. There's so much manipulation that goes into these reports, and there's so many shortcomings with how they're calculated and how they gather the information. Okay, fine. Yeah. But the market fixates on these things. And so we follow this not because we believe this is telling us necessarily the whole story, but because the market reacts off of these things. So we're at 4.1% with the unemployment rate. They expected it to remain at 4.2%, which is what we saw last time. And then the average work week. This is another thing. You notice where the average hourly earnings went up, but the work week went down. So people are making more money by working less, according to this report. It came in at 34.2 hours. I would love to only work 34 hours a week. They expected it to come in at 34.3 hours per week. Last time it was at 34.3. All right, here's some charts. I don't show the chart of the jobs going up and down because we still have 2020 in there, and that skews the whole chart and makes it look all crazy, and it's pretty much a useless chart. But here's the unemployment rate starting to come back down just a little bit over 4% at 4.1%. The hourly earnings are going up here. We're close to that 4% on a year-over-year basis. And the non-farm payroll change, I do show this chart because it's a little more sane to look at. And we can see a really big upward move with what we had in the latest reading. The unemployment rate is coming down. Okay, yeah, election year, vote for me. Look at the unemployment rate go down, even though there's a lot of manipulation in that. So we take what we received on Thursday with the initial jobless claims going back up, but still below its 4-week moving average. The continuing claims are flat, also below its 4-week moving average, and the unemployment rate coming down. That's looking pretty solid now for the employment situation currently. All right, Isabel Net block charts. This is put out by Real Investment Advice, money market funds, the total assets. Money's coming out of money market funds right now, or I'm sorry, the Fed funds rate, that's in blue. It's coming down here, but money is still going into money market funds on this chart because interest rates are more attractive. People are, put your money into a savings account in the bank and you still have to pay taxes on that. Well, you might as well at least get a better return on there. So, and then a lot of money that goes into money markets, yes, some of that will eventually make its way into the stock market. But for a lot of folks, putting it in a money market, that's as far as they want to go. They just want to have an attractive return on their savings. So just to say, well, look at all this money on the sidelines, it's going to go into the stock market, that's not necessarily true. It can be, but it's not telling the whole story with that. All right, then this is another area that I'll deal with over the weekend in the weekly videos with the intermarket analysis, where we look at the valuation of the S&P. And this is the trailing 12 months here, and you take this out, and we're still looking pretty overvalued right now when we compare it to the S&P itself. And I break this down. Oh, this is tech, media, and telecommunication. I look at this in a little bit different way when I go through the weekly videos, but this is trying to take a number of different PE calculations and put them together into one chart. And looking at China, China's been a lot in the news lately. There's a lot of companies that do business in China, but for a long time, I didn't even know China had a stock market. And, they're not really a capitalistic type of society nonetheless, but we are seeing a bit of a bounce right now coming out of this. And but they've been under a lot of pressure lately because they're having some economic issues in China. And then September was the fourth biggest month for central bank policy rate cuts this century. Okay, all right. It's 2024. We're only 24 years into the century now, but they just want to make it sound more grand than it is here. And so not only is the Fed coming in and cutting rates, but other central banks around the world are doing the same thing. Corporate buybacks, people that are buying back their own stock, that tends to be positive. We're seeing the 4-week average going up, and these are buybacks on a year-over-year basis, which we're seeing this slightly above zero right now. And the high yield spread, this is another thing that we keep an eye on right now. And I have other charts that I'll go through over the weekend that show this. They see this going down, which is taken as more positive. And then the debt allocation is at 20%. Now, this means that people are buying bonds because bonds are debt, where stocks is ownership there or equity in that. So folks have been taking some money out of bonds lately, and we've been seeing that. When they take money out of bonds, prices go down and interest rates go up. And then the global stock market cap, it's not quite back to where it was in October 2021, but we're getting kind of close. All right, I looked at Twitter for a while, but I'm just not finding anything all that useful. Here's the intraday chart where we gapped up to R2 as a positive reaction to the employment situation report. Then we came down, fell below R1, and then we just chopped above and below R1 for most of the day. It wasn't until later in the session when we actually saw a little bit of a trend with things going higher, getting back above R2 and closing at the intraday high. And so you can see right in here, this was the big spike up, this light blue area that might be a little hard to see. That's when the employment situation report came out, which is an hour before the stock market opens. And then we saw the pullback, the sideways move, and then going into the close for the weekend here. We did see value and growth doing a little bit better. They were up, but we're still a little bit concerned because the red line is above the blue line. We want the blue line, which is growth, to be above the red line, but we've been seeing that now for a while. And even though the red line's been above the blue line, the market has still been holding up, at least to date. We saw a little bit of improvement here. where we're starting to go up here when we look at S&P growth of value on an intraday basis. We want this to continue to go up to be more positive for the S&P. End of day, growth was up pretty solid, 1.1%, where value was up, but about half as much. Growth was up less for the mid caps and up a little bit more for the small caps. So we're not really seeing much of an improvement here with our small cap growth to value ratio. A little bit of improvement with mid cap growth to value, but we're still seeing a little bit more of an improvement here with S&P growth to value. We want this to go up if we're more positive on the market. A little bit of a tick up from the 250-day moving average when we look at the growth versus value ETFs here, but they're just not showing an awful lot of strength. We want this to go back up and actually get above the rainbow again if we are more positive. Large cap growth, though, is still doing quite well for the time being, above all the plotted moving averages. And this is encouraging, where for most of 2024, we were frustrated by this. But when we look at the discretionary to staples ratio, this continues to go up. So that's actually doing some real positive things for the market right now. Discretionary, those are things that make life fun, versus staples like toilet paper and toothpaste. This going up, that tends to bode better for the economy, and it also is kind of a growth versus value. It's a little bit different, but it's kind of a way of looking at that. Looking at our trend, we're right on the moving average right now, but we're still positive with the green line going up. Short term, also trying to turn up, but not above the moving average yet, but the green line's on top and also going up. So we're seeing a bit of an improvement with these two charts. But we're dropping below average with volume, and that is a concern. You typically want to see an increase in volume when we're going up in a positive environment, and then a decrease in volume when we're going down. Well, we're seeing price going up again, even though we really haven't gone anywhere. We're just back to prices that we were at not so long ago. So for the most part, we're kind of going sideways here. But the idea that we went up and volume went down, especially with a big economic report coming out, just something to be aware of. So our sentiment, we ticked down back below 20 with the VIX on the line chart as well as the bar chart. And when the VIX goes down, the VIX of the VIX also decreases, but it's still above these moving averages here. The momentum of the VIX still continues to be up. And looking at the historical chart here, where we could see the VIX really start to go back up again historically, but it just hasn't really happened other than getting near that 20 level. Because you can see over here, we're at 22, 26, 30 and all that. This was the big crash day that we saw on our August 5th, where everybody thought the world was ending. That lasted a couple of days, and then we got back to normal after that. The skew index is still up in this red area, so the market is still anticipating some kind of a big move. Now, based on this is a variation of the VIX. We don't really know, because sometimes this marks a top, a bottom, or just a continuation. But we've been up in this red area now for about a week, and we tend to not stay up here for very long. So there's still some kind of a big move, according to this chart, that the market is still expecting. So we declined with this one fear gauge. We also declined with this other fear gauge. It actually fell off quite a bit here. So we're seeing more confirmation of fear decreasing in the market right now, which tends to be more positive. Saw a little bit of a tick up here with our risk on versus risk off. When this is going up, that's risk on. When this is going down, that's risk off. And risk on is more positive for the market. We really saw a drop off with the equity put call chart. There was a real big spike up after Thursday. Could have been some hedging ahead of the employment report coming out. Well, a lot of those hedges came off, and so we saw a lot of this, a real big decline with this chart. So that's turning our 5-day back down and our 10-day down as well. That's more positive for the market. Volatility risk premium still going up here. This is showing that there could still be some fear in the market as well. Advanced decline line turning back up, but not breaking to new highs based on price and volume, but still looking pretty healthy altogether. We saw a little bit of an expansion of the new highs, but overall they've been decreasing. So it's causing our 5-day to go sideways, and we're starting to flatten out here with our 10-day moving average. We bounce back up and we're above zero with the advanced decline ratio, both based on 19 periods. I call that short term, and then 39 periods, which is more intermediate term. And we're still above zero here with price with the advanced decline ratio. This also includes volume, where we're also above zero here. So we're looking positive based on volume, both in the short and intermediate term. And we're still looking good here with the accumulation distribution. We're above an advancing moving average here and not necessarily getting an extreme reading. Saw a nice little bounce up here with the Chaikin money flow, with the red line going back up and the histogram also going up. And we're turning back up now with the Chaikin oscillator. So we use these three charts, the accumulation distribution, Chaikin money flow, and the Chaikin oscillator. Those are our smart money indicators that we use together as one bunch. They're now looking more positive. And the vortex also turning back up where the green line had really been coming down. The red line, after getting extreme negative, was starting to come back up, but we saw an improvement in Friday's session. So we ticked up just a little bit here with S&P 500, the cumulative advanced decline line based on price, but we saw a little bit more of an up move here based on volume. And that's one of the things I'm talking about. Volume is looking a little better than price right now. Not really seeing a disconnect between the S&P and the NYSE advanced decline line. They're more, even though they're on different scales, they're moving more in lockstep with each other. We look at the new highs, new lows, this black area that looks like a crazy EKG, that's the daily score. And then down below is this red line, which is a 50-period moving average. It's still having a tendency to tick down just slightly. We want this to go up to be more positive. And then later on, I have another chart of this that's a little clearer to see. We're getting a good solid reading with our 10-day average of the S&P 500 highs minus the lows. And that's showing good, more intermediate term strength right now. This is the other chart. We're still coming down a little bit here with our 50-period new highs, new lows study. We want this to go back up. Looking at the ratio between large caps and small caps, just chopping around an awful lot right now. We were actually small caps outperformed just slightly with the large caps on Friday. This is looking good for the broad market. The cumulative advanced decline line for the NYSE going out and setting a new all-time high. We didn't really see much of an uptick here when we look at our regular NYSE advanced decline line. And here's another regular NYSE advanced decline line. So not really seeing a confirmation with the cumulative measure that we use. Okay, then we break it out based on common stock. We went up based on price, but see how we're setting a new high now based on volume. The new highs, new lows daily score, still positive there. We take a 5-period moving average across the broad market, also looking positive there since we're above zero. And this is another measure based on 50 periods. We are just kind of ticking down just a little bit, but trying to go back up with the 50-period moving average of the new highs, new lows for the NYSE. Looking good here. We never were looking really bad with our advanced decline lines. We're still above the advancing moving average with the NYSE common stock, the S&P, sorry, the NYSE common stock, S&P mid caps. Small caps were able to bounce up off of their moving average. And we're still looking good here with those stocks above our 20-period moving average. We had been declining. We're above 50, so we're positive, but now we're going back up. Also going back up with those stocks above their 50-day moving average, 100-day moving average, and 200-day moving average. Short term, just kind of not really going anywhere. When we look at all of these recent bars together, we had been here before. We did not set a new all-time high with the S&P. But on the bottom, this is the concern, is that we're below the moving average here when we look at the S&P 500 volume. Going back up with the 20, 50, and we're just barely extreme positive with the 200-day exponential moving average just when we measure the S&P itself. And after being extreme negative, the Stochk RSI is now bouncing back up with the update we saw on Friday. We're getting extreme positive with the Williams percent R. We're bouncing back up above the midpoint with the CCI 14, and we're turning back up with the CCI 20, but not extreme with these yet. The condition of the 20-period moving average, we're coming right back up to the lines now. If we can get back above this and see the lines start to go back up, that would be more positive. And we never did get down to the simple moving average based on 20 periods. We got close to the exponential moving average, and that could be seen as support there. And bouncing back up, the blue line's above the red line, that tends to move faster. So for right now, the short-term trend still looks pretty solid. And we're getting extreme with the short-term stochastics, turning back up in the intermediate term, and we never really dropped down, but we're still below the moving average with the long-term stochastic chart. We bounced back up with the force index, and we're still positive. We're coming up into the +1 channel with our standard deviations chart. That's positive. And now we go intermediate term, where we're still below zero with the balance of power. The condition of the 50-period moving average. We came back above both the red line and the blue line. That's turning things more positive intermediate term. And we went from the lighter shade of blue back to a darker blue. So the go, no-go system is looking more positive. And we're above the midpoint and going up with our highest high value here. The TTM squeeze continues to decline though. And I know a lot of you use this indicator. It's a pretty popular momentum oscillator. We got above this black line, so we were extreme. We're still a little bit above it, but when we turn to the darker blue, that's looking more negative. And this is a longer term look at that chart. And as I always like to say here, I put this black line on here. I just kind of eyeball this and go, okay, this is a good place. And I try to pick something around a round number to put that line just to give a point of reference. We're turning back up and still positive with the ease of movement based on 14 days. The Arun is pretty much still on vacation, but it's positive. And we're still negative here with the S&P McClellan oscillator. We were getting pretty low here, almost extreme negative. Well, we bounced up in Friday's session, but we're still below zero. So we're still going down based on price. We could be starting to flatten out based on volume. We're not turning up yet, but we're seeing a little bit of an improvement when we look at volume. We're not really seeing it yet based on price. And we're also negative with the NYSE McClellan oscillator. Even though it bounced up, it's still below zero. So we're continuing to decline with the summation index based on price. But see how it's coming down based on price and a lot less based on volume? This could be positive for the market. We're negative with the Swenlin trading oscillator based on price. We've dropped below zero, where we bounced up off of zero based on volume. Volume is looking a little better than price right now, but price is the ultimate thing that we have to follow. And our momentum still not, it needs more up days to really turn back positive. Or look more positive. We are still positive here with the PMO, but you can see based on price, we're declining below the moving average. And we're right on top of the moving average here based on volume. So volume is holding up a little bit better. So we went back up just a little bit with the PMOs that are rising, but the buy signals are declining, and we're still extreme positive with the PMOs that are above zero, which means the rest of the stocks in the S&P are still holding up fairly well right now. And we've gone from neutral to positive with the Elder's Impulse system for the S&P, but we are still negative with the parabolic SAR. We're going to have to break out above these previous highs and close at those levels to have this dot turn back to being positive. The slope oscillator still above this green line, so it's extreme, but it is declining and below its moving average. The MACD right on top of its moving average right now. So we're actually shifting more negative here in the short term with our oscillators. Intermediate term, also seeing some weakness rolling over a bit, but still positive with the long-term tricks and KST oscillators. We're crossing below the moving average with the Copic curve. We're going back into the initial extreme positive territory with the Sean trend meter, and we are above 50 with the money flow. We're also going back up and above 50 with the ultimate oscillator. We're above an advancing moving average with unbalanced volume, but you can see how choppy we've been here. There's been really no conviction lately. We're above all the plotted moving averages, and this is what I use to determine positive or negative here. Balance of power, after it gave us the bullish percent index, after it gave us a really high reading, started to come down, it went back up in Friday's session. We're also getting a very high reading here with the NYSE bullish percent index and turning back up after declining with the NASDAQ 100 bullish percent index. We're above 50 with the RSI 14 and the RSI 9. That's positive short and intermediate term. And we're still looking good here with our Ichimoku cloud. We're well above the cloud. The blue line's above the red line, and now the green line, which had been declining, is starting to go back up. And we're above this kind of mini rainbow here. This is a 20-period simple moving average of the open, high, low, close. You could say that the green line here, which is the high, acted somewhat as support, but we really didn't hit it. We got close to it and potentially bouncing up off of that. Longer term, a weekly chart of the S&P well above this R2 level, so looking pretty solid there. So we're looking more positive on a trending basis. The Heiken Ashi is now turning back to positive with the open candle. The Kegi is now pointing up where it had been pointing down, and black is positive. The Renko chart, which didn't ever turn negative, is still positive. And after looking more negative with the three-line break, we're now starting to turn back to looking more positive. The long-term chart was still above this 350 level, which I drew the line on here with our 150 and 200-day simple moving averages. And we're positive across the board with the Keller market model. We're negative in the short term with bonds. And we're positive now with commodities in the short and intermediate term, still negative in the long term. The dollar, which had a really good week, it's positive in the short term, but still negative in the intermediate and long term. And only two sectors ended up being down. Utilities, which we've been keeping an eye on, which you could put that as a growth area because of AI and all the crypto mining and so forth. But typically it's a defensive area. And real estate, which it's probably not liking these interest rates going back up. And so they ended up being lower. Where the financial sector is looking good, discretionary is doing better. We want tech and communication. These are the big growth areas. We want them to do well. And then healthcare is also another defensive area, as well as staples. They were up, but not up as much. So saw some red to begin with here with the materials sector having a bearish MACD crossover. Canada doing quite well, setting a new all-time high. The S&P got back above 5,700, and then we have the NASDAQ going above various levels. This is where the BPI for the S&P 500 went back above 80, but I don't put that on the chart that I show. But here, the NASDAQ had a bearish MACD crossover, and that is a concern. And the Dow was down below 42,000. But then again, right going into the close, the S&P ended up dropping. Is that right? It dropped down below 57. I thought we were in the mid 5700s. Okay. Not really seeing much of a disconnect. And this is actually more positive for the broader market with the equal weight. That's the red line doing just as well now as the S&P 500 weighted version of the index. And we came up just a little bit, but we've been really chopping around lately when we do a ratio between those two indexes. The Dow did close at a new all-time high, not by much, but it's still an all-time high. We've gone from neutral to positive with the diamonds, and the NASDAQ not back to an all-time high yet, up over 1%. It did come down to these pivot points, and that's what I've discovered with the NASDAQ and NASDAQ 100. They like these pivot points, and that ended up being a support level that so far we've been able to bounce up off of. We also saw that with the NASDAQ 100, almost down to this pivot point and then bouncing back up and pretty much closing at the high for the session. So we've gone from neutral to positive with the QQQs, with the Elder's Impulse system, and we're still right on the moving average here. We haven't quite crossed negative yet with the momentum of the NASDAQ 100. We want to see this turn back up if we're more positive. If we drop below the moving average, that's naturally going to turn things more negative. And small caps, which really have gone nowhere. They just went back up in the range that they've been in, especially since last summer. But we've gone from being negative to positive with the Elder's Impulse system when looking at the small caps. And then we look at the Russell 2000 small caps, crossing above 50 with the RSI, still above the 50-day moving average. The momentum, though, is still negative. Mid caps just back up into the higher end of the range they've been in now for a while, but have switched from neutral back over to positive with the Elder's Impulse system. Not setting a new all-time high with the Wilshire, but up almost 1% and looking quite solid. This is a broad market measure. And then the broadest market measure that I could find is the total U.S. stock ETF, not setting an all-time high, but still looking pretty solid. Staples to tech ratio coming down, but it's been pretty choppy lately. However, when you look at this ratio, we just saw a recent golden cross here. That means that staples on a trending basis are starting to outperform tech. If this ratio can continue to go down and eventually see a death cross with this ratio, that would be more positive for tech. Financial sector up 1.69%, not necessarily setting a new all-time high, but looking pretty solid. The FANG index has a ways to go to get back to its all-time high, but was up solid on Friday. We're still below this shorter term trend line with the FANG index, but we're still above this longer term trend line. Apple was up 0.5% above its 50-day moving average. Amazon was up 2.5%, also above its 50-day moving average. Microsoft, a little bit of a concern here. We're coming down to the 200-day moving average, and it was actually down on Friday. Are we going to see a death cross here? Now, this is a major player when it comes to tech. So if this thing turns negative, that may have an impact on things. Meta setting an all-time high, and as I've been saying, this is probably the best looking chart out there right now with the Magnificent Seven. Google was also up 0.72% above its 50-day moving average. Nvidia was up 1.68%, but still has a ways to go to get back to its all-time high. Tesla was up almost 4% after it really dropped on Thursday, but still above its 50-day moving average. And Netflix, probably the second best looking chart with the Magnificent Seven here, not setting an all-time high, but still looking pretty solid. And seeing a little bit of a tick up here with the correlation between US stocks and world stocks, but it still has been dropping off lately, where the longer term correlation is still pretty solid. Oil keeps going up here, a 0.91%, getting into the mid 70s now. We're watching this for geopolitical reasons. The dollar is in a downtrend, but man, it came down to just about that 100 level, and it's just been bouncing up like crazy ever since then. For it to go from about 100 up to 102, that's a huge move for the dollar. And we're really going up with the 10-year yield. Now, at some point, if this keeps going up, the stock market's going to notice that. Didn't seem to care on Friday, but at some point it will. And so when we're going up with the 10-year yield, we're going down with the 10-year based on price. And then looking at growth to value, seeing a little bit of a tick up here with Qs to the S&P. Discretionary to S&P, which had been doing better, is back down to its moving average. We saw a little bit of an improvement when we look at large cap growth versus large cap value. So the large caps, mid caps, and small caps, a little bit above their moving averages here, but not really showing any conviction, at least yet. We need to see more follow through. For the most part, we're seeing the S&P to utilities ratio going down. To be more positive on the S&P, we want this ratio to go up. And we are seeing this ratio going down, which is more positive for the S&P. This is staples to the S&P. And when this is going down, that means the S&P is outperforming. And then we have this Hindenburg-Omen. No confirmation yet, but this is still here. We got the initial spike and then the confirmation spike. We're just watching that for right now because we had a similar thing happen right before the COVID crash and right at the end of 2021. But no more spikes as of yet. So what's our outlook for Monday? We are positive and we're wondering, is this weakness going away now? Even though we have this confirmed Hindenburg-Omen and weak seasonality, that just hasn't seemed to matter very much, at least yet. We're going to get consumer credit on Monday, and then we'll see what develops over the weekend, specifically in Israel, between Israel and Iran there. Here is the economic calendar for the upcoming week. We're going to get the FOMC meeting minutes on Wednesday. Then we're going to get CPI on Thursday and PPI and consumer confidence on Friday. Here's another look at what the previous readings were for the economic reports and what the forecast is. Seasonality, we are negative though for October 7th with the Dow and S&P, where we're neutral to negative with the NASDAQ. So we will be on the 5th trading day of the month, and this is where we can possibly see some weak seasonality for the S&P. That's the green dashed line. But Monday in 2023 was the most positive day of the week. So far in 2024, it's up, but it's not the strongest day. It's the 3rd strongest day of the week in 2024. This is the negative seasonality that we've been watching, but it just hasn't seemed to really materialize yet. Here's a new chart showing how going back to 1950 during a presidential election, where September ends up being down, but we were up, and then October ends up being down, and we'll have to see how the rest of October plays out there. So what are the warning signs? We do have this confirmed Hindenburg-Omen and weak seasonality, which are just in the background. They've been irrelevant pretty much to this point, but that could change at any time. We're watching the defensive sectors like staples, utilities, and healthcare. We're also keeping an eye on energy, specifically oil, more for geopolitical reasons. Growth to value did show a little bit of improvement, especially for the S&P on Friday. And discretionary to staples have been looking better, but it didn't do as good on Friday. And the S&P and NYC McClellan oscillators and summation indexes, they are negative now. We need both of those to cross back above zero to turn positive. And the Swenlin trending oscillator, we're going down based on price, but up based on volume. That could be positive, but I kind of base this around what's happening with price, so that is more negative. Parabolic SAR is still negative. In our oscillators, it's going to take more than one up day on Friday, and we're going to have to break out of that range that we're in right now for these to turn back positive. And the positive signs, our three smart money indicators really showed some improvement on Friday. And our 5-day and 10-day equity put call ratio charts are back to going down. That's positive. The advanced decline line still looking good there. We're extreme with the S&P bullish percent index. And we're also positive with the NASDAQ 100 and NYSE bullish percent indexes or indices. Where the vortex, the green line, it was declining, but it did show some improvement. And the red is bouncing up after being extreme negative. The money flow is positive, ease of movement, and ultimate oscillator. These are secondary indicators that I look at that just kind of confirm what we're seeing here. And the NASDAQ 100 momentum, as measured by the PPO, we're right on top of the moving average. So we need to see more of an improvement there. And then the way at the bottom, you have the financial sector, which just seemed, I don't know why this didn't space the right way. So when we take everything together, we are still positive, and that's judging things based on the moving averages. But we have this Hindenburg Ullman and weak seasonality in the background. Is weakness starting to go away? It's still there, but we did see some improvement on Friday. In the short term, is the weakness starting to dissipate? Intermediate term, are we seeing the weakness starting to go away? It's looking better, but it's still there for right now, where we are still positive in the long term. Thank you. I really hope you have a great weekend, and I will talk to you in the next video.